The Reserve Bank of India has retained its FY23 inflation projection at 6.7%, with Q2 at 7.1%, Q3 at 6.5%, and Q4 at 5.8%, based on its assumption that the Indian crude basket's price would be lower than before at $100 per barrel in the second half of FY23, and retail inflation is projected to reduce to 5% in the first quarter of FY24. The RBI has also revised its FY23 growth forecast only marginally to 7% from 7.2%. But the Organization of Petroleum Exporting Countries and its allies, collectively known as OPEC+, pulled a shocker this Wednesday. They have decided on cutting oil production by 2 million barrels per day, a move that will again push up crude oil prices. Despite pressure from the US to pump more crude to help the global economy, the new production cap levels will come into force from November this year and remain in place until December 2023. From their recent low of $82 a barrel around the 26th of September, Brent oil prices have climbed over 13% to more than $93 a barrel at present. Some analysts believe that Brent is likely to top the $100 per barrel mark. We spoke to Paul Hicken, a commodities expert, to understand what kind of floor has been set by the OPEC Plus move for oil prices for the next few quarters.
The producer group is seeking to send an unambiguous message to the market about a willingness to reduce supply to support rising price objectives. Clearly, there's a sign to say $90 a barrel is the psychological price floor. It's a floor that potentially OPEC Plus will look to defend. While there's a lot of volatility, it certainly seems for now that $90 a barrel is something that at least the producers are looking at as a sign of stability.
From its high of $116.01 per barrel in June, the monthly average price of the Indian basket of crude oil fell to its lowest level in FY23 at $90.29 per barrel in October. An impact on these prices is possible since the Indian basket of crude oil represents a derived basket comprising the sour grade, which is the Oman and Dubai average, and the sweet grade, which is Brent dated, in the ratio of 75.62 is to 24.38. According to a UBS report, the price of Brent could shoot up to $110 per barrel by the end of December 2022 and hold at $125 per barrel in 2023, all the way till the end of September. If these projections hold true, the consequences would be dire for India due to higher inflation, lower consumption, and a worsening of the external sector situation. Ultimately, the country's growth rate would be compromised. The retail inflation rate reversed its 3-month downward trend in August, rising to 7% from 6.7% in the previous month. While not everyone agrees that the price of oil will shoot up to the extent projected by UBS, with increasing crude prices possibly raising inflation, how concerned should India be on the growth front?
In the latest policy, the RBI has spoken of crude oil price averaging $100 per barrel for the second half, which would broadly be in line with what could be the possible impact on account of this particular cut which has been invoked by OPEC. So right now, if they move it up to say something in the region of $95 or $100 per barrel, to my mind, I don't think that would upset any of the official inflation calculations. See, we were toying with a price right up to $120 per barrel when the Ukrainian crisis erupted. After that, we've seen the price being in the range of around $100 to $110 per barrel. And our growth remained more or less resilient to whatever was happening externally and whatever was happening to crude oil price. So today, I would say that anything up to the level of, say, $95 to $100 per barrel is something which could be tolerated by the economy. And there could be a case of saying that overall growth may not be impacted much. And we could still be looking at growth in the region of around 7% for this financial year.
India imports over 86% of its oil requirement. A rise in prices will mean that India's import bill will also increase. As a result, the current account deficit, or CAD, will widen. India's April-June CAD came in at $23.9 billion, or 2.8% of GDP. This represented a 15-quarter high. There were apprehensions in some quarters that the CAD could widen all the way to 5.5% of GDP in the second quarter, which would be the second worst quarterly deficit on record. One agency had estimated that CAD could widen to a decade high of 3.8% of GDP in FY23. In FY22, the CAD was 1.2% of GDP. So, what will be the impact of the OPEC Plus move on India's increasingly vulnerable external sector?
We are talking of this deficit, current account deficit being in the region of around 3.5% of GDP. I think it was premised on the fact that global commodity prices have also eased enough, come down, and the CAD is going to be affected more because of the global recession. But today we're talking of a situation where moving from 90 to even 95 or 100 would definitely mean that our trade balance would get widened, which in turn would put pressure on our current account deficit and finally the balance of payments. So the external sector is something which would definitely be vulnerable to any kind of an increase in crude oil price.
The overall situation remains dynamic. In September, Russia bounced back to become India's second largest crude supplier. However, pressure from the US continues on this front due to the war in Ukraine. The Wall Street Journal recently reported that the US could conditionally ease sanctions on Venezuela, allowing Chevron Corp to pump oil in the country. Meanwhile, the US has accused OPEC Plus of aligning with Russia after the group agreed to the deep production cuts. The US has also said that it will continue to release oil from its strategic stockpiles. The anti-cartel legislation, known as OPEC, which had been considered by the US in the past, was also brought up when reports said that President Joe Biden would work with the US Congress on legislation to curb OPEC's control over energy prices. For their part, the challenges for the Indian government and the RBI will depend on exactly where crude prices land. At the very least, they will have one more major challenge to contend with on the external sector front.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.